Most investing advice sounds the same. Buy stocks. Add some bonds. Hold long term. But almost no one talks about the other parts of a portfolio, the ones that don't sound exciting, don't get hyped on social media, and don't promise big returns. Yet, these overlooked pieces can be the difference between sticking to your plan and panic selling at the worst possible time. Today we're talking about what belongs in a portfolio that people rarely talk about and why beginners should care. The problem with stocks-only thinking. Stocks are powerful. They build long-term wealth. But portfolios aren't just about maximizing returns. They're about survivability. Many investors fail not because their strategy was bad, but because they couldn't stay invested during market crashes, job, unexpected expenses, emotional stress. That's where the ignored parts of a portfolio come in. Cash, the most underrated asset. Let's start with the least exciting asset of all, cash. Cash doesn't grow much. It doesn't compound. And it's often criticized for losing to inflation. But cash has a superpower. It gives you options. Cash helps you. Avoid selling investments at a bad time. Handle emergencies without debt. Sleep better during market volatility. Take advantage of opportunities when markets fall. For beginners, cash isn't wasted money. It's insurance. How much cash makes sense? Cash doesn't mean stuffing money under a mattress. It usually means high-yield savings, money market funds, short-term low-risk vehicles. A common guideline: 3 to 6 months of expenses for emergencies. More if your income is unstable. Less if you have strong job security. Cash isn't about returns, it's about resilience. Defensive assets nobody gets excited about. Next up, defensive assets. These don't usually outperform stocks over the long run, but they tend to hold up better during tough times. Examples include bonds, treasury securities, inflation-protected securities, low volatility funds. Their role isn't to win every year. Their role is to lose less when stocks struggle. For beginners, defensive assets. Reduce portfolio swings. Make investing emotionally easier. Help you stay invested. Alternatives, helpful but not magic. Alternatives are anything that isn't stocks, bonds, or cash. This might include real estate, commodities, gold, REITs, infrastructure funds. These can help diversify a portfolio, but they're often misunderstood. For beginners, alternatives should be a small slice, not the core. Complexity can increase risk, not reduce it. Diversification only works if you understand what you own. Alternatives can help, but they aren't shortcuts to higher returns. The real role of these overlooked assets. Here's the key idea. These assets exist to support your behavior, not just your returns. They help you avoid panic selling, stay disciplined, stick with your plan, invest consistently over time. The best portfolio isn't the one with the highest theoretical return. It's the one you can hold through bad markets. A simple beginner framework. A beginner portfolio might look like growth assets for long-term wealth, defensive assets for stability, cash for flexibility and emergencies, optional alternatives for diversification. The exact mix matters less than having all the roles covered. You don't need complexity. You need balance. Final takeaway. Investing isn't just about picking winners. It's about building a portfolio that works in real life, not just on paper. The assets people never talk about often matter the most when markets get tough. And for beginner investors, those quiet, boring pieces can be the reason you succeed in the long run. If this helped, consider sharing it with someone starting their investing journey, because these are the things people usually learn the hard way.